So let's discuss now with Ranesh Ramanathan, co-leader of Aiken, Gump, Strauss, Hauer and Feld's Special Situations and Private Credit Practice. So talk to us about how this is working, Ranesh. How are the banks able to get in on this without breaking any rules, regulatory-wise or agency-wise?
I think we're seeing this at its very nascent stage right now, Bonnie. Banks are still trying to figure out how they want to play in this market. I think, as Paula pointed out in her article, and I'm going to give Paula a shout out there, this is a situation where banks are trying to find a way to replace the fees that they've lost in their leveraged lending business as private credit has become a more dominant player. And so navigating that space and finding a way where you don't have to deploy your own capital, because as we've seen, banks have a significantly higher capital charge now being assessed to these sorts of riskier assets, is what they're all trying to do. And at this point, it's very much a throw spaghetti against the wall approach and see what sticks.
Well, are there any big risks? I mean, could anything go wrong that might be systemic, maybe not to the banks, but to the plumbing, let's say? Is it anything like the CLO craze?
No, I mean, I think we need to recognize that private credit's not new. Private credit has been around for decades. It's taken different forms in different markets. We're just seeing much greater prominence today of private credit because of the tightening credit markets and rising interest rates. And companies need for creative capital, right? So this is not a new product. This is not a highly levered product. This is not a situation where unknown risks are being taken. These are sophisticated players who've been in the market for decades, lending to companies like this over a long period and have a very solid track record.
And Ranesh, as the Bloomberg Big TIG story also highlights, you alluded to this, if you're not part of this trend, do you lose out on other lines of business, everything from cash management to M&A advisory? I mean, how much does that end up being part of this story?
I think that's the tricky part that banks are trying to balance today, right? Their relationship with a customer is much deeper than a private credit lender's relationship with a customer. They have banking relationships. They often have FX, hedging, other types of facilities that they provide to a borrower. Whereas a private credit lender is looking at this situation as a credit relationship. I'm lending to you, I'm taking a certain risk, I'm taking certain security over that, and I'm expecting to get repaid. And that's it. That's the full scope of the relationship. I think banks are realizing if they can no longer lend and they can do these other facilities, they become less valuable to that customer, and they want to prove their value to the customer by being the one-stop shop, right? A place where you can go and get all of your banking needs taken care of. And so that's what they're trying to balance through these relationships. Sorry.
No, on that relationship subject as well, what's the relationship look like if banks are partnering, let's say, with some of these specific funds that are being set up to capitalize on the private credit boom right now? I mean, some of those funds obviously were speaking to the fact that they were seeing an opportunity because the banks hadn't been providing some of that lending in the first place.
I think it's a very symbiotic relationship that you could see between the banks and these credit lenders. And it's a mix of who has the money and who has the relationships. The credit lenders have a lot of capital. As you talked about, it's a $1.5 trillion market today and only growing from here. The banks, on the other hand, have the relationship. If you're a company in the Midwest and you're looking to raise money, right, you're looking to borrow money for an expansion, for an add-on acquisition, you know how to call your neighborhood bank. You know how to call JP Morgan. You know how to call Citibank. You have no idea how to call Blackstone or Bain Capital or Carlyle. The banks acting as a bridge to build that relationship between the borrowers who don't have the access and the private credit lenders who do have the capital and are willing to lend in that space could be a really beneficial relationship.
Really quickly, Ranesh, who's going to decide on what interest rates charged and what fees charged and, who pays what to whom?
I think that's going to be part of the relationship between the bank and the private credit lender, right? Figuring out how do you manage the underwriting process? How do you manage the terms of the deal? And then, as was mentioned in the article, how do you manage when you're faced with a default situation where the bank may have a different incentive than the lender? I think all of those are things that we'll see being worked out in each of those relationships potentially differently.
All right, Ranesh, really great perspective. Thank you very much.